Thanks, everybody, for being here.
Thank you.
Can you just start by asking how many of you are investors in any form? Equity stocks, mutual funds, AIF, PMS? Okay, good. So, how many of you have invested in a portfolio management service product? Anybody? Okay, yeah, good. We have to have two or three of them. So Adagri runs a portfolio management service, which is a very refined form of investment management, and we'll come to that in a little while. Before that, let's understand from Adagri what it thinks about equity markets. Adagri, the last 4 years, we had after the COVID, we had a fall and then a big move in the markets, probably more than 100% returns over the last 3 to 4 years across large caps, mid caps, small caps, and valuations looked a bit stretched also. But in the last couple of months, we have seen some amount of correction in the markets. So, what do you think at this juncture? What is the outlook for India and Indian equity markets broadly speaking?
Yeah, thanks, KK. Firstly, I would thank the organizers for this opportunity. Very interesting to see a lot of participation in this session. Hopefully, this session will be useful. We'll throw a lot of insights for all of you. On the markets, KK, yes, you're right. It's going through a very turbulent phase after having a one-way run for almost 2-3 years. The markets have, the indices level have doubled in the last, 1.5 to 2 years. Now we are seeing a sharp correction. So just to share, give you a sense of how deep is the correction. I'll share some numbers for you. Since the indices hit the peak last week of September, a lot of these broader market as well as the benchmark indices are down by about 10% plus. Be it Sensex, mid cap, small cap, look at all that. Across the spectrum, the indices are down by about 10% plus. And that doesn't tell you the full story. Actually, if you go down and look at some of the stocks, especially in the momentum space, space in which a lot of momentum trade was done, like your PSUs, defense, property, real estate, energy transition. If you look at all the sectors, the stocks are down by almost 40-50%. That's quite a severe correction. So the investors are wondering, what has caused this level of correction? Most of the, in my investment community, there is a general assumption that this has been triggered by Chinese stimulus measures, the so-called China rebalancing, trade allocation by FIs. Yes, of course, that was that triggered the first leg of correction, where it set off a huge FI selling in India starting from September 26. And stimulus measures announced by China, in fact, triggered this correction, and that doesn't explain the kind of sell-off what we saw in the month of October. One is not very sure, because I'll just share you some numbers on FIs. FIs have sold close to about $12 billion in the month of October. This is a big number, because if you relate to even at the worst of COVID times, they sold only about $8.5 billion. This $12 billion, of course, it's only in the secondary market. If you adjust for some investments in primary market, they have sold net about $10 billion. Is it only the China the reason, or is it something else which triggered this level of FI sell-off in Indian equities? While this China trade reallocation was happening, there were two more risks that hit India very, very heavily. One was, there was a kind of a cyclical slowdown in corporate earnings, which came in the quarter two earnings. That is one reason. The second risk which hit, which is much more relevant, is something called Trump trade. The market started factoring in Trump's win much ahead of the election outcome in the month of October, and as a result, you started seeing the U.S. Treasury yield as well as the dollar index moving up very, very sharply. So these were the three factors which triggered such a large correction in Indian markets. Now the question, as you are asking, the most of the investors' mind is whether this correction is going to be sharper, deeper, or will it rebound?
Yeah, no, you see the points you made, right? The growth in earnings of corporate India slowing down. We're seeing consumption slow down around us, etc. Inflation has been continuously between 4 and 6%. The US, we have a new government where Trump is coming in, and there could be a lot of policy changes that can happen. Valuations expensive. So given the slowing economy and all that, so what is your expectation going forward as an investor? What should they do?
Okay, so to get that answer, whether this correction is going to be sharper or is there going to be a rebound, and what kind of market direction one can look at. We got to look back, got to go back and look at all the three factors which played on this correction. The first one is the China factor. That excitement is gone now. It is, China's stimulus effect on the market has fizzled out now. So that's now it's behind us. In fact, the last few weeks in November, there was a sell-off in China. Money started moving out of China. The second factor is what you're talking about in terms of India's cyclical slowdown. But I think there is some hope, because if you look at the October numbers, high frequency indicators they call, in terms of GST collection, in terms of IIP numbers, and in terms of even export trade numbers, October you are seeing quite a sharp rebound. Probably I think the tactical or technical, or you could call it as a short-term slowdown, what we saw in corporate earnings, probably is behind. One is not sure, probably we'll know when the Q3 earnings are out. But the third reason, which again accelerated the correction, which was the Trump trade. In our view, I think the Trump trade is overdone on dollar index as well as the US Treasury yield. Probably technically it's right for a reversal. That will, in turn bring a lot more FI flows into India. India might see a technical rebound going forward because the selling is overdone. But on the question of valuations, I think India is extremely and richly valued at this point of time. So going forward, the expectation on returns from Indian markets needs to be muted, and at the same time, the India's long-term story is quite intact. That's what I would say, KK.
See, there is a general view that the US dollar is losing its place of preeminence, right? The Trump trade reversed a little bit of it, but generally with China becoming larger, Russia becoming another force, and India aligning with Russia, China, the other axis that's getting formed with Saudi Arabia. So this dollar is going to be losing its position of relevance. People call it a de-dollarization trade or what was happening. So medium term, what is your perspective on that?
This is a $1 million question. Not anybody, I think it's difficult to predict. But at the same time, I think if you look at the reasons why there is increased sound bites on death of dollar domination, primarily there are two reasons. One is in the last decade, if you look at the Chinese trade settlement, in dollar, it used to be 85% settlement about 10 years back. That has moved now about just 50%, which means 50% of China's trade is getting settled in yuan. That's one reason. Second reason, as you rightly said, there is increasing efforts, unified efforts from BRICS countries to come out with a currency called unit for trade settlement. This is one side of the story. But the one which, if you want to really separate the signal from the noise, the place where you need to look at is how central banks are managing the reserves. I found some surprising data. Like if you look at RBIs, we have about $680 to $700 billion. A lot of it is in dollar assets. And except that 8 to 10% of gold reserves, the rest is all in Western countries' currencies. Be it sterling, euro, or is it yen, or it is in dollar. So no other currency in the reserves. And surprisingly, if you go and look at even Chinese reserves data, this is what is the most surprising thing. It's very classified information. Broadly, what we see is almost 55% of their reserves are dollar-linked assets. And the rest is again in euro, sterling pound, and in none other currencies. So the place where you have to look at is what central banks are doing. Central banks at this point in time, in terms of diversification outside dollar and Western currencies, very, very limited. So at this point in time, de-dollarization is more of a hype and nothing concrete except in trade settlement. But I would be closely watching out. What is central banks are doing in terms of how they are diversifying their reserves, then what's happening on the trade data.
Sure. Thanks, Arnav. I think from whatever we read and whatever Arnav also mentioned, I think India is a great story for the long term. There could be some bumps ahead and some correction in the markets when valuations are extreme and growth slows down, etc. And when probably a bit of FAI selling is there in the markets, we do get an opportunity to see the markets lower. So I think we do believe here broadly that Indian equity markets are a good place to be in from a longer term. So in this scenario, I would just like to ask Arnagiri also, how does he look at an advice, if you were to give an advice for youngsters here, how should they build wealth? What kind of asset allocation, what kind of instruments they can use, and any tips for not trying to time the market? If you can give some thoughts.
Yeah, actually, financial planning, if you look at it, it's no rocket science. It's a very simple stuff. But a lot of these intermediaries and the financial intermediaries make it complex. If you look at financial planning in a conventional view, they would say that your asset allocation should be driven by your age. Right? If your age is X, 100 minus X should go to equity, and the rest should go to debt. This is what the conventional view on financial planning, which we don't subscribe to. In our view, I think the asset allocation should be driven by liquidity needs, the emergency needs, and the contingency needs. So once you decide what is required for your liquidity needs in the next 2-3 years, the rest of the money which is blockable, that should always be invested in high yield assets, so that you get the power of compounding. In the conventional view, what happens if I'm 60 or if I'm 50, almost 50% of the money I'm forced to block in debt, which loses your power of compounding, which hardly catches up with your inflation, which means you lose your purchasing power. But in an unconventional view, in your reserves, if only 20% is required in the next 2-3 years, and 80% is blockable, then that should go to high yield assets like real estate and equities, which can give you much higher compounding. So that's what I would say. Basically, your liquidity needs should drive your asset allocation. Coming to timing and timing out of the market, there is a general tendency that time the top and time the bottom by most of these youngsters and traders. I wish I could do this. Most of the investors can do it, that you can time the top and time the bottom, but you will know the top and bottom only in hindsight. Very, very difficult to know ahead, which means the best way to create wealth is to be always in the market, which means time in the market creates wealth, not timing and timing out. And that's very critical for youngsters to understand, so that they can create this power of compounding over a long period of time.
Thanks. So, gentlemen and ladies here, what we are seeing is broadly, if you take different time periods, a return of about 12 to 14% is possible from equity assets, be it mutual fund schemes or units or investing into the markets in a very passive way. So examples are, if you take any mutual fund product which has a history of 10, 15, 20 years, you would find on sites like Value Research, online.com, etc., that they give you about 12 to 16% compounding returns basically. So let's see how Arnagiri delivered 18-19%. So can you explain a little bit about your portfolio management schemes which delivered this 18-20%?
Broadly, if you look at the product structure which are available for investors, it starts with mutual funds, then it goes to PMS, and then it goes to alternate investment fund. We are present in both PMS as well as in alternate investment fund. Mutual funds are primarily targeted towards retail investors who are, who are beginners in terms of savings, so their surplus levels are low, and their risk-taking ability is limited. So SEBI has got a lot of regulation restriction to make sure the mutual fund addresses the retail segment. They don't lose out, by any accidents. There are a lot of regulations, and at the same time, high net worth individuals who have saved a lot of money, who are in their peak of their career, they have a lot of surplus. They look for specialized product, personalized construction, where there's little more risk is allowed by SEBI. That's where PMS comes in and alternate investment comes in. PMS comes with 50 lakhs minimum ticket size, and alternate investment comes with 1 crore ticket size. We have delivered, we have been around for the last 20 years, and we have delivered about 18% by simply following one simple philosophy, which is, buy right and sit tight. We don't attempt to time in and time out of the market. We stay invested across the cycles, but we make sure that we have discipline to buy right and then sit tight through the cycles to create this level of value creation.
Thank you. And definitely, I think there's a lot of merit in what Arvind says. Invest for long term, stay invested, and you will make really tons of money and become a crorepati over the next 10 years. Thank you, gentlemen and women, for being patiently listening.
Thank you. Thank you. Thanks a lot.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.